Okay, looking at the introduction to financial products and customer needs. So these are the syllabus objectives. We have to describe the main types of social security benefits and financial products and explain how they can provide benefits on contingent events which meet the needs of clients and stakeholders, right? And then explain the main principles of insurance and pensions that impact on these benefits and products. Also, we have to describe the ways of analyzing the needs of clients and stakeholders to determine the appropriate benefits or on contingent events to be provided by financial products. So, in our previous video, we did look at these objectives and a bit of summary of the content. So, now we'll go through the items in a bit more detail. So, as a financially aware individual, if someone asks you what your financial needs are, you should be able to have a good attempt at providing an answer, right? For example, you might come up with the following financial needs. You may say that you want to pay off any debts that you owe, or you want to save for retirement, to save for a house purchase, or to pay off a bond, right? And then you also might say you want to protect yourself, your dependents against sickness, debt, or unemployment. And you might also want to protect your household contents against theft and protect your property from damage. And yeah, so with these needs, with these financial needs, there are financial products in the financial services market, normally provided by insurance companies and banks, right? So it comes as no surprise that for each of the needs identified, financial products have developed just the products to meet those needs. A whole range of benefits is available, which can be categorized into benefits on events that are unpredictable, both whether and when they might occur, and benefits on events that are certain to occur, but they are unpredictable in time. So for events that we did highlight this as well in our previous video, that for benefits on events that are unpredictable, we might think of, and they are unpredictable on when and whether they will happen, right? Something like a car insurance. Someone may purchase a car. We are not sure whether and when that car will be involved in an accident. Someone may own a car like forever without it being involved in an accident. Whereas someone may buy a car today and then tomorrow it's involved in an accident. So both the timing of the event is uncertain and the occurrence of that event is unpredictable. We cannot know for sure when it will happen, on whether or not it will happen. And then benefits on events that are certain to occur, but we can't predict the time. An example of that event is death, right? We know for sure that every single person alive today will die at some point. But as to when they will die, we cannot predict the timing. So those are benefits on events that are unpredictable. The first one, both whether and when they might occur. The second one, the event is certain to occur, but we can't predict the time. And then there's benefits for immediate consumption, such as when you fall sick immediately, you will need medical attention immediately. There are financial products for that, for meeting that need of immediate consumption, or there are hospital plan products, there are medical schemes to meet that kind of need. So there's also benefits on events that are predictable in time, something like a retirement benefit. Someone aged 40 knows that they might retire in 60 years' time. in 20 years time if the retirement age is 60. And then there are benefits from the accumulation of disposable income and capital, right? So those are investment benefits or saving products. So this chapter, along with the next 3 chapters, give an overview of the different types of financial products that can be used to meet customer needs. This chapter, along with the next 3 chapters, give an overview of the different types of financial products. This chapter, along with the next 3 chapters, give an overview of the different types of financial products that can be used to meet customer needs. This is mainly background reading. However, since most exam questions are based around one or other of these financial products, it is very important that you can grasp now the benefits or cover each product provides. This chapter also covers the main principles of insurance and pensions that impact on the design of such financial products and benefit schemes. If you don't feel comfortable with any of the financial products as you come across them, we recommend that you do one or more of the following. Get some basic information on the financial products from the internet, for example, on Investopedia, insurance products and pension, on thisismoney.co.uk and moneyadviceservice.org.uk. So have a look at any pension scheme and insurance document that you have in respect of yourself or your property. Read the money section in a quality weekend newspaper. Speak to other students or colleagues, or look at the discussion forums. All right, so now we are looking at the types of provision. So in some countries, the state provides certain benefits directly to its citizens. This is called social security. Where these are at a low level or not offered at all, individuals and organizations are often prepared to pay another party to protect themselves against the risk of certain events happening. The main types of benefits. In some countries, the state provides certain benefits directly to its citizens, such as social security. Where these are at a low level or not offered at all, individuals and organizations are often prepared to pay another party to protect themselves against the risk of certain events happening. The main types of social security, financial products, contracts, schemes, transactions fall into the categories described in the following sections. The financial products are the basis for much of the remainder of the course. A general definition of a very brief overview of these main categories is given in the rest of the chapter. Details of insurance and reinsurance products are given in an appendix. This provides a general indication and example of the type of product that examiners may describe in examination questions. The examiners will not be testing detailed knowledge of the products, but will expect students to be able to apply their understanding of principles to both these basic product types and to other products that may exist independently, or where 2 or more of these basic contract types are combined as a package. The appendix mentioned in the core reading above is rather long and so has been included as the core reading in the next 3 chapters of the course. So that is the chapter on benefits overview and providers of benefits, the chapter on life insurance overview and life products, the chapter on general insurance overview and general insurance products, and then now looking at social security benefits. States vary considerably in terms of the type of benefits they offer to their citizens, the amount of benefits offered, and whether or not that benefit. States vary considerably in terms of the type of benefits they provide to their citizens, the amount of benefits offered, and whether or not the benefits are means tested. A means test is an assessment to determine eligibility for benefits. For example, an individual may only be eligible for a specific benefit if they earn less than a certain level of income per year. Alternatively, the means test may be based on the level of an individual's assets or perhaps a combination of both income and assets. Where means testing applies, there may be a financial disincentive to individuals to make alternative private provision. Okay, social security benefits. States vary considerably in terms of the types of benefits they offer to citizens, the amount of benefits offered, and whether or not the benefits are means tested, right? A means test is an assessment to determine eligibility for benefits. For example, an individual may only be eligible for a specific benefit if they earn less than a certain level of income per year. Alternatively, the means test may be based on the level of an individual's assets or perhaps a combination of both income and assets. Where means testing applies, there may be a financial disincentive to individuals to make alternative private provisions, meaning if maybe where means testing applies, there may be a financial disincentive to individuals to make alternative private provisions. Something like income grant, right? For old age grant in South Africa, right? So, because someone who doesn't qualify, or because if say someone doesn't have enough retirement savings, that are below a certain level, they may qualify for income grant, right? So now say that person knows for sure that if they earn below that, if they don't have, now say that person, if they don't have that level, they are below the threshold to receive old age grant. They won't make any means to save for retirement if they know that the state will cover, right, that benefit. So that is where it says that there may be a financial disincentive to individuals to make their alternative private provision, because we know that the government will provide, so why bother putting in the effort to make a private provision? Citizens may or may not be required to contribute towards the cost of social security benefits. In some shape or form, citizens do contribute, especially the working class, right? They do contribute in the form of taxes in providing the cost of that benefit. So, but then the beneficiaries of those social security benefits, they hardly contribute, right? I think for people who are not paying any taxes or who are unemployed and not earning any income, the only form of taxes that they pay is through VAT when they buy goods and services, or yeah, that's one that I can think of. And then the rest of the people who are working in some companies, they have to pay income tax. So But then citizens may or may not be required to contribute towards the cost of social security benefits. These benefits are subject to the political risk that the state may change or withdraw benefits in the future. Say, if there's a change in government, right, there might also be a change in government policies. Say, for instance, in South Africa, currently the ANC is in power, and then with the next election, say the DA wins majority of the votes, the policies of the ANC versus the DA are probably completely different. I don't know the details, but I suspect or expect that they would be different in some areas. Say the DA is not in favor of providing social grants to citizens, and the ANC is in favor of providing social grant. If the ANC is overthrown or loses the election, then the next government will advance their policies. And if in their policies that there shouldn't be any income grant or any social grant, then that benefit might change. So there is a risk to the individuals that the state benefits may change or may be withdrawn, right? So yeah, these benefits are subject to the political risk that the state may change or withdraw benefits in the future, right? The main possible types of benefits offered are retirement pensions, including survivor benefits, medical care, for example, the National Health Service. Okay, that's in the UK, but then in South Africa, of course, we do have public clinics and public hospitals where anyone who can not afford private medical care can go to those public clinics and public hospitals. So those are benefits that are provided by the state, right? And then there's income support due to unemployment, illness, or disability. We also have that in South Africa. But then the unemployment part is a bit tricky in our case because people who are unemployed are earning 350 or 370 now, which was introduced during COVID. I think before COVID, if you were unemployed and you are not eligible to receive the old age grant, or you don't have any disability but you are unemployed, then you are screwed, right? But then even if you do receive the 350, 370, it can only do so much in terms of sustaining your life. So you are still facing some hardship, I expect, because that money can't do much in terms of sustaining your life. It can only meet you halfway here and there. So, but then other state benefits or social security benefits are fully covered by the state, such as public health services, as I've said, like with public clinics and public hospitals, and retirement pensions to old age people who are above 60, who don't have any private retirement savings. They are they are entitled to receive the old age grant. And then there's housing support due to low income. I think child grant does come into play in South Africa. And then there's long-term care support. All right. Now, moving on to the financial products and contracts. So financial products and contracts. We have insurance contracts. Under insurance contracts, in return for a single or a series of payments, the provider will pay an individual or any has an agreed amount or a series of amounts that start and end on the occurrence of a pre-specified event. This event may happen to the individual's property, or a third party, right? The flexibility of the terms in this definition make it very general. Incorporating a full range of insurance contracts, for example, many long-term insurances like life or health may have a series of premium payments. Shorter-term insurance like motor insurance, travel insurance are more likely to have a single payment. Most insurances that are not contingent on life are paid to the insured individuals, while those that are contingent on life would normally be paid to their heirs or their dependents or their beneficiaries. And then the series of amounts widens the definition to include, for example, income benefits paid to the death of the insured life. The series of amounts widens the definition to include, for example, income benefits paid on the death of the insured life and long-term sickness or income protection benefits. Inclusion of the events happening to a third party ensures that various liability insurances, for example, employer's liability, are encompassed by that definition. So, yeah, that is just the definition of life insurance or of insurance contracts. Under insurance contracts, in return for a single premium payment or a series of payments, the provider will pay an individual or their heirs an agreed amount or a series of amounts that start or end on the occurrence of a pre-specified event. This event may happen to the individual's property, or a third party. Okay. And then there's reinsurance contracts. A provider of insurance may not want to retain all of the risk that is accepted from individuals or companies. A provider of insurance may not want to retain all of the risks that it has accepted from individuals or companies. Instead, the provider can pass on or cede some of the risk to a reinsurer in return for paying an appropriate reinsurance premium, right? So providers of insurance products can pass some of the risks that they take on to third parties through reinsurance contracts. Risk transfer is covered. Okay, risk transfer is covered further in the content. The passing on of the risk is also called ceding the risk. You are passing on the risk to the reinsurer as an insurance company, but then you do pay a reinsurance premium. So the reinsurer doesn't cover that risk for free. Okay. The way to think about it is that insurance contracts are between the normal insurance company and the individuals or companies that buy the insurance. And then reinsurance contracts are between the insurance company who covered the individuals. It is between the insurance company and the reinsurance company. So reinsurance is insurance for insurers. Okay. And then pension schemes. A pension scheme involves the accumulation of funds which are paid out on a later event, usually retirement, but the event may also be death or withdrawal from the scheme, right? Okay. And then we have insurance principles. There are three main principles of insurance and pensions that impact on the design of financial products and the benefits that can be provided from such products. There are three main principles of insurance and pensions that impact on the design of financial products and benefits that can be provided from such products. Meaning that actuaries, when they develop these insurance products or pension products, there are some principles that they have to consider when developing the product and the benefits that are provided by those products. So those principles, or those three main principles, are the existence of an insurable interest, the pre-funding of the risk, and the pooling of risk, right? On insurable interest, in most countries, an insurance contract is only valid if the person taking out the contract has a financial interest in the insured event. That is insurable interest. If I take out insurance, do I have a financial interest, or do I see the need of taking that insurance? Do I see the financial need to take out that insurance? If, for example, I insure my car, it is because I do have an insurable interest, because say my car gets damaged, I don't want to go through the financial hardship of sourcing money from elsewhere to pay for the damages of the car. So I do see the financial need of taking out that insurance. So this is primarily to prevent moral hazard, fraud, and other crime, right? So in other words, the policyholder must have an interest in the claim event not happening and will not encourage it to happen. So if I insure my car, I do have an interest in it being insured, but I don't want it to get damaged or get stolen, right? And I shouldn't want to motivate that event of it being damaged or stolen so that I can claim from my insurance, right? So we are sort of like thinking about it in the worst case scenario basis. Whatever that I have insured is for the worst case scenario, but I don't want that worst case scenario to happen. If my car is insured, I am covered if it gets damaged, but ideally, I don't want it to get damaged, right? So that is insurable interest. So we said, in other words, the policyholder has an interest in the claim event not happening and will not encourage it to happen. This is in theory, but in practice, people do shady things. So a moral hazard is the idea that the policyholder behaves differently in a way that may increase the likelihood or size of a claim because they have insurance in place. So a moral hazard, say, because I know that I have insurance, now suddenly I'm reckless in my driving, because if my car gets damaged, I know that the insurance will pay for it. Or because I know that I have insurance, all of a sudden, like, I just leave my car there without locking it, but it's in public parking spaces. So those are moral hazards. We normally or ideally want to prevent moral hazards, fraud, and other crime. So because that you have insurance, your behavior shouldn't change because you have insurance. So the moral hazard is that because you know that you have insurance, suddenly you behave differently in a way that may increase the likelihood or the size of a claim because you know that you have insurance. For example, if an individual could insure a building in which they had no interest against fire, then they could raise money from an insurance company by setting fire to the building. I think something, so yeah, if you don't have insurable interest in something, say you insure a property that doesn't belong to you, you probably don't care much as to what happens to that property. Say you insure a car of someone, maybe it's your friend, you don't care much about your friend's car as much as you do with your own car. So you could motivate or you could encourage the claim. You could encourage what's this? You could encourage the claim event to occur. because it's not your own property and you don't have any insurable interest. I think another moral hazard, especially mostly in black communities, is with like funeral covers. You'll find that maybe one person has insured a lot of people for funeral cover so that they have an insurable interest that if they have the, or they don't have the insurable interest, but they do have someone insured. What I want to say that you'll find someone not closely related to some extended family member, but they do have them on their funeral policy. Whenever that family member passes away, because that person is insured in some funeral policy, the policyholder will get a payout, even though they are not closely related. And because people do shady things to a certain extent, someone may encourage the claim event to occur. Say you know that you have insured someone. I'm not encouraging fraud or crime or any ill doing, but this is what moral hazard is about. Say you know that you have insured someone, say, how do I put this? Say that person A insures person B on a life policy, but person A doesn't really care much about person B, so they could care less if whether they get sick, they die, or whatever. So, but they have them on their insurance policy, right? Say a funeral policy. But because they don't have an insurable interest, they don't care if that person dies or not, they have them in their funeral policy either way. They could benefit if that person dies. So if they see that this person is living longer than expected, some could encourage the claim event to occur, meaning some people do get killed because they are on insurance policies of others. That's just how it is, because people insure people that they don't have an insurable interest in. Say it's an extended family member, you haven't seen them for years, but you are on their insurance, or you do have them on your insurance. If they die, their death doesn't impact you as it does to their close family members. But if they die, you could claim from your funeral policy, right? Okay, not to dwell much on this, but that is just how insurable interest and moral hazard works. So we said, for example, an individual could insure a building in which they had no insurable interest against fire. They could then raise money from the insurance company by setting fire to the building. In the case of funeral policies, they could raise money from the insurance company by killing the other person that they have insured. They have insured that person, but they don't have insurable interest, right? But then obviously, the insurance companies do verify claims, or they do check. They do their own investigations to check the cause of the insured event and so on. So that person might risk getting arrested because that is crime. If you just caused fire to some building because you want to claim from an insurance, or if you kill someone just because you want to claim from insurance, that is crime and you could be arrested, right? So individuals are generally assumed to have unlimited financial interests in their own lives and the lives of spouses and dependent children, but other financial interests are limited in amount to prevent over-insurance. Okay, so an example of this is funeral covers, right? So there is a maximum amount that you can cover another person for. say maybe it's your spouse, it's your child, if you take out funeral insurance, maybe there could be a limit that you cannot cover them for more than 100K, right? Or you cannot cover them for more than 50K, because the main purpose of funeral insurance is to cover funeral expenses. So why do you want to cover someone for 1 million, but it's a funeral cover? It doesn't make sense. But yeah, it doesn't make sense. But then people do take out multiple insurance covers for the same person, right? So that they can benefit financially if the other person dies, unfortunately, right? Yeah. So individuals are generally assumed to have unlimited financial risks in their own lives and the lives of spouses and dependent children, but other financial interests are limited in amount to prevent over-insurance. Over-insurance, why do you insure someone on your funeral policy for 1 million or 2 million? Because the payout is meant to cover funeral expenses, unveiling, and so on. Why do you want to cover them for 2 million? So that is over insurance, right? So that is why there are limits to the amounts in certain types of insurance. Okay? So that was on insurable interest. We are still on the insurance principles, and we are still on the three main principles of insurance and pensions that impact on the design of financial products and the benefits that can be provided from such products. So insurable interest, pre-funding, and then now we're on pre-funding. The key principle of insurance and pension is that individuals or corporate bodies put money aside. The key principle of insurance and pensions is that individuals or corporate bodies put money aside in advance of the occurrence of an uncertain risk event. The key principle of insurance and pensions is that individuals and corporates put money aside in advance for the occurrence of an uncertain risk event. The uncertainty might relate to whether the event will happen at all, such as the risk of fire or flood, the timing of a certain risk event, such as life expectancy, the cost of an event that is certainly going to occur. Pre-funding, we are putting money aside in advance for the occurrence of an uncertain risk event. Pre means before, funding means to put money towards something. So we are putting money in advance for the occurrence of an uncertain risk event. The uncertainty might relate to whether the event will happen at all, such as the risk of fire or flood. Whether the timing of the certain risk event, such as life expectancy, the cost of an event that is certainly going to occur. And then the key issue for individual or corporations is that how much money is needed to provide for a given level of benefit with the desired probability. This will depend on the probability of the risk event occurring, the amount the risk event will cost, and the return that can be earned on the pre-funded money before the risk event occurs. So the way I'm understanding this is that because we want to ensure some uncertain future event, right? Ideally, we don't want that future event to happen. But if the likelihood of it happening what will it cost if it does happen, right? So that is why on insurance premiums, the higher the likelihood of the risky event happening, the higher the premium. I think it's called risk premium. The higher the premium. So and that is why also, if it is certain that some risky event that we won't want to happen will occur, that is why in some cases people may be declined insurance. Say you want to insure your grandmother who is 200 years old. Chances are you can't take out life insurance for them, or they can't take out life insurance for themselves, because the life expectancy, or because the likelihood of them dying, the probability of them dying is very high. So the insurance company ideally wouldn't want to take on that kind of risk, because the event is certain to occur quite soon, or the probability of that event happening is very high. So yeah, it wouldn't make sense, or the cost of providing that death benefit would be very high. So okay, so that is just some side tangent, thinking out loud. And then we will end about, okay, I was on the key issue for individual or corporation. The key issue for the individual or corporation is how much money is needed to provide for a given level of benefit with the desired probability. This will depend on the probability of the risk event happening, the amount that the risk event will cost, and the return that can be earned on the pre-funded money before the risk event occurs. Right, so the premium charge will reflect these points, right? Okay. The individual will also have a risk tolerance. How comfortable they are with the probability of the desired outcome not being achieved. Risk tolerance. And then the third principle is pooling of risk. As an alternative to financing benefits directly for themselves, individuals may group together and pool their finances. This approach will help to protect the individuals against some of the uncertainties that may exist in the cost of financing the benefits. It may also lead to more cost-effective provision than if each individual made their own financial provision. So pooling of funds is cost-effective, right? And then retirement communities, a trade union, okay, I'll skip this. Micro insurance, okay, there's retirement communities and micro insurance. What it says is that a trade union on retirement communities is that a trade union, an employee association, or a community or religious organization may be a way in which individuals can group together to form such a pool. An approach that is common in other countries like the US is the establishment of retirement communities. These originated as religious organizations into which members would contribute their available assets in return for lifetime care. More recently, the idea has developed to provide different levels of continuing care, including housing, according to the levels of initial and annual contributions. Continuing care retirement communities have also started to be established outside of the US. Okay, so explaining why the provision of such long-term care is less of a concern in many less developed countries. we take care of our people, guys, like grandmothers and grandfathers. We do take care of them, I think. And then life expectancy as well. Okay, life expectancy may be a factor, right? Life expectancy outside the US may be shorter, right, than in developed countries. If this is the case, then a smaller proportion of the population will reach old age, and therefore fewer will require long-term care, or at least require it for a shorter period of time. So in addition, family structures are often strong with higher fertility rates. This results in a greater burden of care being placed on the family. Like I said, we do take care of our own grandparents. And yeah, I think maybe in other developing countries, but yeah, apparently I think it's true that life expectancy generally is lower in developing countries than in developed countries. So there's more old age people in developed countries. I think in theory, or the idea is that there's more old age people in developed countries than there are old age people in developing countries. So that is why in developed countries they see the need of providing for long-term care. And also family structures may not be that strong in developed countries compared to developing countries where people or families are much more dependent on each other. And there's also high fertility rates in developing countries, and birth rates are also high. Grandparents have a lot of grandchildren who can take care of them. So the burden is placed on the family more than it is on the more than so there is a burden that is placed on the family for long-term care, so that to a point that they don't see the need of providing for long-term care. So especially in African families, it is not a common thing to put on your grandparent to a retirement home. And a lot of the grandparents are quite stubborn as well. They prefer to die in their own land because they see that if you take me to a retirement home, I'm just going to go there to wait for death. It would rather find me in my homeland and stuff like that. But so that is why I think it is long-term care is less common in developing countries. Not that it's not there, but it's just less common. And also the idea that life expectancy in developing countries is not that high. So if someone is old, they won't be old for that long. They will soon die. So you don't see the need of long-term care. But in developed countries, you'll find old people living for longer. Okay. And then microinsurance. Various microinsurance examples exist. For example, basic life and health insurance in deprived communities in developing countries. Various microinsurance examples exist. For example, basic life and health insurance in deprived communities in developing countries. These policies offer basic benefits at a low premium. The insurer can benefit from pooling large volumes of business. So numbers count in microinsurance. And then on to banking and banking products, right? On to banking and banking products. The operation of a bank. Banks form a key part of the financial services sector, right? We depend on banks for most of our financial transactions and financial needs, banking facilities. Imagine how hard it would be to transact without banks, right? So they play a key part on the financial sector. And then we have types of banks. We have retail banks, investment banks. I think I did cover this before in my previous video on banks. I think I was on institutional investors. We had commercial banks or retail banks and merchant banks, and then investment management companies. Yeah. Okay. But then on the types of banks, we have retail banks and investment banks. Retail banks are banks that provide a range of savings and loan products to individuals and to small businesses. So these are normal banks, like I said before, your Capitec, Absa, Standard Bank, FNB, whatever banking account that you have is provided by a retail bank. And retail banks provide banking facilities, ATMs, EFTs, cash withdrawals, banking cards that we use to pay for goods and services. They also provide loans, special purpose loans like vehicle finance, mortgages or bonds, credit cards. So a lot of our transactions depend on banks. Banks provide banking facilities to normal people and organizations. Those are retail banks, right? And then investment banks undertake a range of activities, for example, helping large businesses raise further capital through share and bond issues, advising large businesses on mergers and acquisitions. I think these are merchant banks, like I've discussed before, that they are the main players when it comes to mergers and acquisitions, and they play the advisory role to various companies, right, that want to do mergers and acquisitions. Those are merchant banks, but in here they describe them as investment banks. I think I should let me just Google the difference quickly between a merchant bank and an investment bank. Let me say merchant bank versus investment bank. So Google says that a merchant bank often focuses on private equity, corporate finance for smaller or mid-sized firms, and direct investments, while investment banks typically serve large corporations, governments, and institutions specializing in underwriting securities, IPOs, debt, and acting as intermediaries for complex public market transactions. I think when I discussed this was also the role that was played by merchant banks. They play they play roles in mergers and acquisitions, private equity funding, initial public offerings, and then I think there's not much of a difference between investment banks and merchant banks, right? Yeah, in terms of the roles that they play. Okay. So investment banks undertake a range of activities, including helping large businesses raise further capital through share and bond issues, advising large businesses on mergers and acquisitions, providing trading services for bonds, equities, and derivatives, investing directly in the market, such as speculative investments in derivatives with the aim of achieving high returns. And then we're still on the types of banks. Yeah, retail banks and investment banks. And then the assets and liabilities of a bank. The assets of a bank will be any cash and other securities, such as bonds that are held, right? Banks do buy bonds and they do buy other financial securities like shares, derivatives, mostly the short-term ones, because liquidity for a bank is very important. But they do have assets. They do have, I believe they do have short-term and long-term assets, right? Bonds, equities, derivatives, property, all in all asset classes. I do believe they have some ownership there. So the assets, but they obviously have a purpose in each of the assets that they hold or that they have. I believe they allocate a majority of their funds into short-term assets like bonds and money market instruments. Because of the nature of their business, liquidity is important for a bank, right? And then long-term assets they might own as well. So the assets of a bank will be in cash, will be in any cash and other securities such as bonds that are held, together with the future repayments expected from any loans issued to customers. So loans are assets of a bank. They are a liability to you and an asset to the bank, because they will receive interest from those loans. So that is an form of income for the bank. Right, and then liabilities of the bank will primarily be the deposits placed with the bank by individuals and businesses, given that the customers will want to withdraw their funds at some point, right? So if I have deposited money in my bank account, I might go there tomorrow and want it back. So they owe me that money now, right? It is in their banking account. It's my money. They can use it to lend it to other people. But if I go there tomorrow and say I want to withdraw my money, they should be able to pay it, right? That is why I say liquidity is very important for a bank. It can't be the case that I go there, I want my money, and say, no, you can't receive it today. Try us in the next 2 months or so. So liquidity is very important for a bank. But then obviously, if you have a fixed deposit account, there are terms and conditions as to when and how you can withdraw, right? You can't put your money in a fixed deposit account that, say, it matures or not maturing, but a fixed deposit account, say you do have a specific term for that deposit account. Say maybe you put in money and you say you'll put it in there for 5 months. The next thing you want to withdraw it tomorrow, there will be penalties. But for a normal savings account or a current check account, I can withdraw my money at any time, right? So I can't be told that it's not available. So they owe me my money. So that money that's in my bank account, it is a liability to them, because I could want it back at any time, and they have to be able to pay it. But the money that I owe to the bank, it is their asset, because I have to pay it to them, right? The initial capital that they borrowed me, including the interest. So that is their asset. And then I believe the other form of liabilities for the bank is that if they have issued bonds, meaning they have borrowed money through bonds, through the issuing of bonds, then that is a form of liability, right? Because they have issued a bond to raise capital. So the buyers or the purchasers or the investors who buy those bonds, they will expect some investment returns. So the bank has to be able to repay that. And then that's on the assets and liabilities of a bank. And then banks and exposure to risk. So banks are exposed to a number of risks, including customer defaults on repayment loans, interest rate changes, which can negatively affect the business. For example, a fall in interest rates reducing the repayments on variable rate loans, failure of processes such as poor data handling and IT issues. So banking infrastructure like ATMs, wire transfers, their banking platforms. So those are IT related issues, data handling, there's a risk. The data has to be safe and secure. People's personal information can't be compromised. Banking facilities need to be in good standing at all times so that there are no interruptions, right? Those speed points have to work. If I do an EFT, the money has to go through. If I go to the ATM, it has to work. So if those are failures of processes. They do face the risk of failure to their processes, right? And that is why sometimes if you go to your banking app, some of the features, you find that some of the features during that time that you visit your banking app are down, say due to maintenance. So that is so to prevent failure of their processes, but then they do normally notify you when something will be disrupted, right? It can, they have to do ongoing maintenance on their facilities and infrastructure. And then they also face the risk of fraud. People do rob banks, so that is some form of risk. And then even fraud from their staff. I think that is also some form of risk. And then failing to meet regulation. Yes, this is the case. Banks are being fined for failing to spot and act on money laundering, right? Regulators do fine banks if they don't meet regulation, right? If you visit the FSCA website, you will see some fines that were issued to some of the popular banks in South Africa, even the popular financial institutions like insurance companies, because the regulators issue regulation and then these financial institutions have to be compliant, right, with that regulation. If they don't comply, they can be fined for non-compliance. That is why if you are working for a financial institution, there is a compliance officer who ensures that all the staff working for that institution do know about money laundering, financial crime, and what is this one? The financing of terrorism, and so they have to be compliant, including their staff has to be compliant to work there. Because they also work with people's information. There's the POPI Act. If they don't protect customers' data, they could be fined for that. If maybe say customer information sort of like leaks due to some data breaches that the bank didn't take care of. So there is that risk of failing to meet regulation, right? And then they can be fined for that. And the amounts that I usually see is like you say that, okay, a certain bank has been fined 10 million for non-compliance, right? So, and then there's also failing to meet capital requirements. The Prudential Authority, as part of the regulator, does monitor the financial position or the financial standing of financial institutions, including banks and life insurers. There are capital requirements. So what they do is that they look at the liabilities and the assets of the bank or of the financial institution. So given the assets of that bank, their liabilities, there would be a specific capital requirement for that specific financial institution. So if they fail to meet those capital requirements, that is another breach of regulation, right? So they can be fined for that as well. And then there's cash flow issues, an extreme example of which would be a fall in confidence in the banking sector and a run on the bank. So a bank run. So that is an example of a liquidity risk. Like I've explained that if I go to the bank tomorrow and say I want to withdraw my money, they can't say that we don't have it. right? And then if I go there and I experience that, okay, I can't withdraw my money, and then I might post on social media that, hey, I went to this bank and tried to withdraw my money, and then they said that, we don't have it, try tomorrow. Other people as well might decide to go to the bank and test if their money is still there, right? And then if a lot of people rush to the bank to withdraw their money, the bank might face liquidity issues because they don't normally, under normal circumstances, they don't expect a large number of withdrawals in a short space of time. Say if all of us banking with Capitec, we go there right now and say we want to withdraw our money, the bank will face liquidity risk, right? What if they don't have that money and all their customers want to withdraw their money? So that is a liquidity risk. And then banks and the role of actuaries. So actuaries can provide support in many areas of the bank, including risk identification and management, data management and modeling, product pricing, asset liability management, meeting capital and liquidity requirements. Okay. And then banking products. Banks offer a range of different products aimed at saving, investment, and borrowing. Current accounts, these are flexible bank accounts that allow both saving and borrowing. There are multiple payment methods from the account: cash withdrawals, debit cards, regular payments to third parties, such as direct debits and such as direct debits and debit orders, online and mobile payments, checks. Not anymore in South Africa. Banks no longer issue checks, right? Yeah. I think the last time I've seen a check is 2016. Yeah. I think after the checks were phased out, and then current accounts may allow a saver to deposit money into or withdraw it from their account at any time they wish. Current accounts may allow a saver to deposit money into or withdraw money. Current accounts may allow a saver to deposit money into or withdraw it from the account at any time. Yeah, those are current accounts. I may deposit money and withdraw it at any time. I can deposit now and withdraw it same time. So those are current accounts. That is why liquidity is important for a bank. And then current accounts may also place a limit on when the customer can withdraw their money, referred to as noticed accounts. All right, there are limits as to when I can withdraw my money. I don't know about that. I haven't seen it. I think I would expect that if I want to withdraw my money, I should receive it now. So if there are limits on when I can withdraw my money on a current account, on a normal current or check account, I don't know about that. Maybe I can't withdraw at midnight. I don't know. So they're saying here that the notice period is often 30 days, 60 days, or 90 days. I think those are just fixed deposits in a South African context. So interest rates on notice accounts. So those are notice accounts. Okay. Interest rates on notice accounts are normally variable. Notice accounts often pay a higher rate of interest than instant access accounts, since the deposits are more valuable to the bank because these balances do not require the bank to hold a liquidity buffer. Okay, that makes sense, right? So if I have a 90 days notice account, the bank would expect that the money will be in that account for 90 days, so they don't have to hold a liquidity buffer in case I want it tomorrow, like in a normal check account. So with liquidity accounts, they also know that, okay, we can use this money. We have access to this customer's money for 90 days, so we can lend it out do whatever, invest it, but they do pay interest on that because of the time value of money, number one, and I don't know what else. Yeah, but then they do generally reward customers who put their monies in fixed deposit accounts. Some current accounts will have overdraft facilities, which is a flexible borrowing facility linked to a current account. Say I'm currently on 0-0, but I'm still able to spend. I think that's an overdraft facilities. And current account overdrafts are generally treated as unsecured loans. Yes, those are unsecured loans. So as overdrafts are not secured on any particular asset of the account holder, they are riskier from the bank's perspective, and therefore a relatively high interest rate is likely to be charged by the bank to reflect that risk. And then there's credit cards. This is a form of credit with an agreed borrowing limit. The credit card holder can spend up to the agreed borrowing limit and must pay back the minimum amount each month. This is a form of unsecured borrowing and therefore likely to attract a relatively high interest rate, right? The credit card may offer some incentives for new customers, such as 6-month period where no interest is charged, right? But then that is just a promotion from the bank side. It has to comply with regulation as well in South Africa. Whatever financial product or financial facility that the bank provides, it has to go through regulation. They can't simply make any type of promotion. Say if the credit card may offer some incentives for new customers, 6-month period because this will encourage borrowing, right? If you know that you won't be charged interest for 6 months using your credit card, that is a promotion. It will encourage borrowing. So regulation, I think what the National Credit Act has to come into play, that you can't just simply lend money to anyone. You have to vet them, look at their financial position. Will they be able to pay? In other words, there shouldn't be any reckless lending, even if there are those types of promotions. And then now on loans, a loan is an amount borrowed by an individual, such as a personal loan, or a company, which is a corporate loan. Loans may be secured or unsecured. A secured loan is a loan backed by some form of financial asset, often referred to as collateral. This financial asset can be taken by the bank in the event the loan is not paid back in line with the terms of the loan, right? So uyabambisa, you are putting something, maybe you have your house as collateral for some secured loan. If you can't pay it back, then the bank will come for your house. An unsecured loan is not secured against another asset. An example of an unsecured loan includes current account overdrafts, unsecured personal loans, and credit cards. Unsecured loans carry a greater risk to the bank than secured loans. So generally, unsecured loans charge the highest interest because of that risk. That the bank, there is a chance that the bank won't get their money back, right? The initial capital and the interest. So, and then a personal loan is a loan taken out by an individual and paid back over a fixed period, typically 1 to 7 years. Interest rates on personal loans are often fixed for the life of the loan. I think in South Africa they are often variable, right? They are linked to the prime lending rate, which is in turn linked to the repo rate. So when the Reserve Bank, So when the Reserve Bank changes the repo rate either up or down by those basis points, the prime lending rate will also be affected. In turn, the interest rate on a customer's loan will also be affected. So that is the personal loan interest. Okay, one example is a car loan. Car loan is also a form of a personal loan, but it's secured. It is taken out to buy a car and secured on the car. Otherwise, personal loans are generally unsecured. Okay. And then corporate loan is a loan that is a loan by the bank to a company. Corporate loans are normally variable rates. Personal loans in South Africa are also normally variable rates, right? Unless if it's a unsecured personal loans, I should say, unless if it's a vehicle finance or a car loan. Those ones you can opt to have a fixed interest rate or a variable rate, right? But then the fixed rate is usually higher than the variable rate, right? Yeah, because I don't know exactly why that's the case, but I would like to think is that if you opt for a fixed interest rate, you are sort of like insuring yourself against interest rate volatility. If for some reason if currently the prime lending rate, what is the current prime lending rate? Let me just check. Current prime rate in South Africa. So currently the prime rate is 10.25%. So if for some reason, if you take out a fixed interest option on your car loan, it will generally be higher than the prime lending rate or than a variable interest rate. If, say, a bank charges you prime plus 2%, meaning if you take out a car loan, say on a variable interest option, they could say they charge you prime plus 2, which means that if the current prime lending rate is at 10.25%, then your interest on your car loan would be at 12.25%. That variable rate that you get will generally be lower than a fixed interest rate option. A fixed interest option could be prime plus 3%, for example, and locked at that prime lending at that rate, right? So you could be charged on a variable interest rate option, you could be charged a 12.25% if the prime is 10.25, but on a fixed interest, you could be locked at 13.25%, right? For the entire duration of your car loan. If it's 6 years, you will pay 13.25% for 6 years. Whether the prime lending rate goes up or down, it doesn't matter. So that is sort of like some form of certainty from your side as the consumer that you want fixed installments. You don't want your car installments to be going up and down. But for the bank, they sort of like lose out. For the bank, if the prime lending rate or if the repo rate, which is linked, if the prime lending rate goes down and your interest is still fixed at 13.25%, they are making more in terms of interest from your car loan. But then if the prime lending rate goes above that 13.25%, for example, and you are locked at 13.25%, you see the benefit of having the fixed interest rate on your car loan, right? Okay, not to dwell too much on this, but that's generally how it works. And then on mortgages. All right, on mortgages, this is a loan taken out to purchase property, like a house, an apartment. So, and it is generally secured on that property, right? In the event that the borrower defaults, the lender can sell the property to recover its debt. In this situation, there is a risk to the bank that the value of the property is low at the point of sale, and the amount of sale and the amount received is not enough to meet the outstanding debt and interest. So your car, on your home loan, your house is collateral, right? If at some point you are not able to repay that money, say maybe you lose your job and you can't continue paying for your house, the bank will sell or auction the house, and then in order to recover their money or to settle the outstanding debt. But say you owe the bank 1 million, and when they auction your house, they can only get 700,000. So there is that risk that at the point of sale, the amount that the bank receives may be insufficient to meet the outstanding balance and the interest. So now, so mortgages may be residential mortgages where the borrower lives in the property. They may be buy-to-let mortgages where the property is rented to a third party. They may be commercial real estate, right? And then interest on those mortgages are normally variable, but may be fixed, right? Mortgages. So mortgages in South Africa, we commonly call them home loans. So capital is normally repaid over the term of the loan, right? This is called a repayment mortgage or repayment loan, because each payment covers both the capital payment and interest. So it is a repayment loan. It is not an interest-only loan, where in an interest-only loan, during the term of the loan, you only pay interest and only repay the initial capital at the end of the loan. So in a repayment loan, during the term of the loan, so your installment is made up of your interest payment and the capital repayment, right? So as you progress through the term of the loan, in the beginning, a large portion of that installment goes towards paying interest, but then as you progress, a large portion goes towards the capital portion, right? So this is called the repayment mortgage or loan. Early payments on the mortgage will primarily be used to meet the interest cost, but over time, more of each payment will be used to repay the outstanding capital, as I've explained. But in some cases, interest-only loans may be available. With an interest-only loan, the regular repayments or the regular payments made by the customer are only to meet interest cost, with the full capital amount being outstanding throughout the term of the loan. The customer will then need to find or to the customer will need to have funds available to repay the capital at the end of the mortgage. I wouldn't recommend this to anyone, even for myself. If I'm borrowing money today to buy a house, say I borrow 1 million to buy a house, and then the term of the loan is 20 years. During the 20 years, I'm only paying interest. But at the end of the 20 years, I have to have some 1 million somehow to pay for the house. If I don't have that 1 million today to buy the house, where am I going to get the 1 million in 20 years? So, that type of arrangement, I don't think it would be a good idea to anyone. It's like a balloon payment for cars, eh? Like, you don't have deposit for your car. You don't have, right now you say you buy a car, you don't have a deposit to put down when you buy that car, but then you have a 40% balloon that you will have to pay at the end of the car, or at the end of the term of that loan. So if you don't have the deposit right now to pay towards the car, where are you going to get that 40% balloon at the end of the loan? So some of these financial arrangements, I don't know with people who take them. But then, yeah, there are options, but there are options. The good thing is that there are options. What works for one person may not necessarily work for another person. Maybe for the other person, it is more important to own a car right now than stressing about balloon payments that will only be in 6 years' time or whatever the contract says, right? But then for other people, we are only, yes, we do want cars, but financially we shouldn't be under strain, right? Because saving, especially in South African economy, is quite difficult to save money. It means that if you have a balloon attached to your car, for example, during the term of that loan, you should be saving up money towards paying for that balloon payment. If you are not saving or putting money aside to cover that balloon payment at the end of the loan, it means that you could have to give up your car if you can't cover the balloon, or you could opt to take a personal loan to cover the balloon payment, right? So with a balloon payment, your installments will be less, right? But your installments being less, you should be able to save up money for that balloon payment, right? If you are not saving up money with your less installments, where are you going to get the 40% balloon to pay towards a car, right? So interest-only loans and the balloon payment arrangement or the residual value arrangements, I wouldn't recommend to anyone or to myself. Okay, so now mortgages may be residential. All right. I was on interest-only loans, right? Okay, now we're on to personal protection insurance. Personal protection insurance. This is a form of insurance that ensures that loans are repaid if customers are unable to make the payments because of accidents, illness, disability, or death. Like I said in my previous video, that usually with these loans, there is some form of insurance that is attached, which is called credit life, right? Credit life insurance, it is attached to credit. If you borrow money with a bank, especially for unsecured credit or unsecured loans, with secured loans, credit life insurance, they may or may not attach it because there's security. If you can't repay due to illness or death, they can simply take that collateral, such as a house or your car. They can simply take that and auction it to cover the outstanding balance, right? But then with unsecured loans and unsecured credit, if something happens to you, the bank doesn't have a way of recovering the money that they have lent out to you, that they have borrowed you. So normally there is some form of life insurance that is attached to those types of loans. It's called credit life insurance. And with you, each and every single installment that you pay towards that loan, there is a portion that is for the premium to that insurance. As your outstanding balance goes down, that insurance premium also naturally goes down, because it is insured against the outstanding balance. So as the outstanding balance goes down, the insurance premium on that credit life, or the insurance premium also goes down, right? So that is for unsecured loans. And then credit life will usually be for accidental death, illness, disability, or normal death. So those personal protection insurance, I call them credit life. They are insurance that ensures that the loans are repaid if customers are unable to make the repayments because of accidents, illness, disability, or death. The product might also repay the loan if the customer is made unemployed. Okay, I don't know much about that for unemployment. Maybe it's maybe it does cover retrenchments as well. I don't know. Yeah, I don't know about that one. But I think it is there, right? The product may also repay the loan if the customer is made unemployed. Not if you are fired, maybe if you are retrenched or something. All right. Because some losing your job in most cases is outside of your control. But if you are fired, it means probably you have something to do with it. Maybe they might not cover that option. I don't know. So the mis-selling of personal protection insurance in the UK has led to the largest customer redress scheme that is specific to the UK. They're saying the mis-selling related to banks encouraging consumers to purchase personal protection insurance when the product did not meet their needs, for example, because they were self-employed and therefore the product would not pay out. They had alternative provisions for accidents and illness, for example, through their employer. Okay, and then there's asset-backed securities. This is a bond backed by a ring-fenced pool of assets. The asset-backed security is a way of repackaging future loan repayments and selling these repayments to an investor in return for a cash sum now. For example, if a furniture business that offers loans to customers to buy sofas and then receives the loan repayments with interest in future, may at some point wish to repackage the outstanding loan payments, sell them, and in return receive a cash payout. A cash payment now, okay. An investment bank would normally be involved in this repackaging with the business selling its current loan book to the bank. Okay. Investors who purchase the bond receive the interest and capital repayments on the loans, less an administrative fee to meet the bank's costs. The bank will normally divide the loans into homogeneous groups, for example, by likelihood that the loan will be repaid, its maturity date and interest rate. This creates different tranches of loan with different levels of associated risk of being repaid in full. All right, I think this is something that I need to read a bit further on, right? And then asset-backed securities are normally issued in tranches, often called A, B, and C, with different yields and different levels of risk. Under this structure, tranches may get high credit ratings and may be sold to institutional investors. Institutional investors with specific guaranteed liabilities to pay and regulatory requirements to meet may be unwilling to take. Institutional investors with guaranteed liabilities to pay and regulatory requirements to meet may be unwilling to take too much investment risk and so would be attracted to the higher security offered by Tranche A. Investors are repaid through interest and capital payments made from the pool of assets. Investors are repaid through interest. Investors are repaid through interest and capital payments made through Investors are paid through interest and capital payments made from the pool of assets. Asset-backed securities may be backed by mortgages, car loans, unsecured personal loans, credit cards, or other types of loans. Mortgage-backed securities is a particular example of an asset-backed security. With a mortgage-backed security, the bank will repackage the outstanding repayments on mortgages that are due from customers and sell to investors. A bond is created on which the payments to investors are made from a ring-fenced pool of mortgage assets. Okay. And then now we own derivatives. Banks act as intermediaries in the derivatives market, helping to match sellers and buyers of derivatives and earning a commission fee. So banks also participate directly in derivative markets as buyers or sellers. A derivative is a financial instrument whose value depends on the value of other investments, such as shares, bonds, or variables, for example, interest rates or exchange rates. Providers of financial products, schemes, contracts, and transactions can pass some of the risks that they take on to third parties through reinsurance contracts. With reinsurance, derivatives can also be used to pass risk to a third party. Derivatives are discussed, okay, all right, we'll look at derivatives later on as we go through the course. All right. So an investor who holds, so we have to describe how an investor can protect themselves against the risk of a fall in the value of these shares using derivatives. So an investor who holds shares in a big supermarket chain. So an investor could sell a futures contract on the supermarket shares, that is, enter into an agreement to sell the shares on a specified future date at a price agreed now. Buy or put option. All right, okay, this is on derivatives. I won't go into the details. Then we have investment schemes. Investment schemes involve an individual paying a single payment on a series of Investment schemes involve an individual paying a single payment, or investment schemes involve an individual paying a single payment or a series of payments to a provider with the expectation that a higher amount will be paid back at a later stage. An investment scheme involves an individual paying a single payment or a series of payments to a provider with the expectation that a higher amount will be paid back at a later date. Yeah, this is just the basics of investments. You put in money today, you expect to receive more money in future. Again, the generality of the definition enables it to incorporate a wide range of investment schemes. It therefore includes savings products offered by insurance companies, such as unit-linked savings plans, collective investment schemes such as the investment trust companies and unit trust. These products, okay, so we'll end that one there. And then now on to analyzing stakeholder needs. Logical or emotional needs. This refers to two possible approaches to establishing a customer's needs, right? There could be a logical approach of systematically and carefully working out what needs what needs a customer has and fitting products to those needs. We are working it the logical or emotional. With logical, there's a logical approach of systematically and carefully working out what needs a customer has and fitting products to those needs. An emotional approach for the emotional needs involves an emotional approach which plays more on what an individual feels is needed, right? So those two approaches can lead to the identification of some of the same needs. It is important to differentiate between emotional needs and the logical needs of the customer. If the customer's emotional needs are met, they may get what they want rather than what they actually need, right? So giving examples of emotional needs. So examples of emotional needs include an individual may believe they have a need to generate additional income in retirement from investment capital. But this may be an emotional need. On analysis, it may be that the customer's expenditure levels will fall on retirement and that the level of additional income required may be very much lower than perceived. Another example includes spending money today on enjoying oneself in preference to protection or savings, such as on gambling or going on a spending spree, right? Providing overly generous death benefits for dependents than what we actually need. Emotional needs, excuse me. Emotional needs also include wanting more benefits than is needed. Okay. The logical needs approach involves establishing the customer's needs, analyzing them, prioritizing them, and fitting the benefits or products provided to those needs. So there is a reconciliation between the products and the needs. The process of analyzing and prioritizing financial needs is called fact finding, right? That is the process of analyzing and prioritizing financial needs. It is called fact find and is often carried out by financial advisors. Most of these financial institutions, banks, and insurers do have financial advisors because some of these financial products can only be bought through advisors, right? Some of them. I think especially with even insurance, right? Those salespeople, those call center people, those ones they normally would be like that call center person reaching out, calling you randomly, asking you about, are you covered, are you not? They will ask you some series of questions before signing you up as a customer, right? So in them asking you questions, I think they are sort of like evaluating those needs, right? Yeah, and also with and with also retirement annuities, those products, especially those ones, they are bought through financial advisors. They do that fact finding, which is a process of analyzing and prioritizing your financial needs. A customer's logical needs can be analyzed as follows: maintaining a current lifestyle. A customer's logical needs can be analyzed as maintaining a current lifestyle, protection, for example, against death, loss, illness, or accident, accumulation for a known purpose such as income in retirement, repayment of a mortgage, or the accumulation for a purpose as yet unknown as accumulation for a purpose that don't know yet, out of any remaining disposable income or capital. Okay, this may involve taking advantage of any tax efficient arrangements that are available. Excuse me. And then so there's emotional and logical needs, and then there's also current or future needs. So it is also necessary to determine whether a customer's needs are current or will arise in future. A current need is one that has an immediate effect on the customer's circumstances. For example, what would happen if they developed a condition that meant they were unlikely to work again, right? A future need may be one that relates to a customer's future aspirations, for example, to retire at age 55 or pay off a mortgage at a particular date. Some of these needs may be both current and future, right? For example, for someone in retirement, they need to maximize returns earned on capital to provide income while at the same time protecting the value of the capital from the effects of inflation over time is both current and a future need, right? And then attitudes towards risk. In many cases, stakeholders' needs will be greater than the money available to both fulfill those needs and to provide finance for the desired current lifestyle. These are the most difficult circumstances where the individual needs to make hard decisions. Attitude towards risk, we are saying in many cases, stakeholders' needs will be greater than the money available to both fulfill those needs and to provide finance for the desired current lifestyle. So these are the most difficult circumstances where the individual needs the individual needs to make some hard decisions. A key feature of the individual's decisions will be their attitude to risk. A risk-averse individual will prefer protection against future events, even at the expense of a worse immediate lifestyle. A risk-averse individual will prefer protection against future events, even at the expense of a worse immediate lifestyle. As an example, a risk-averse person may prefer to buy insurance for, say, for their car, and forego the option of using that money for something else, because they know that if their car gets damaged, they will have to pay out a lot to fix it. So they would rather forfeit the pleasures of today in order to cover their car, right? A high-risk individual will prefer to work on the assumption that rare events will not happen to them and will prefer to address such events when they occur. Sizobona phambili. A risk-averse person, a high-risk individual will prefer to work on the assumption that those rare events will not happen. I buy a car today, what are the chances that it will get damaged, involved in an accident, right? So instead of me paying that 2,000 or 3,000 rands premium, let me just say that event will not happen and spend the money, right? So that is in the meantime, they use the money saved, but by not making provision to enhance their immediate lifestyle, okay? So it is important that the options and consequences of each possible course of action are clearly set out so that the individual can consider them in detail. Okay. So yeah, that is the end of our session. We'll just stop here.